There we go. And thank you for joining us today. So today we're going to go over the breakdown that I sent you for our third exam. As you know, that third exam opens at 12:01 a.m. tonight. So it will be on My Accounting Lab, just like before, same format. And you saw in the breakdown that there are 40 questions. Some are computational, some are non-computational. They come from a pool of questions. So those are randomized and they're algorithmic. So everybody receives a unique exam that way. So it's open book, open notes, no other resources. Do your own work, no one to help you out. And complete the exam in one sitting. You have plenty of time, 150 minutes. So that will be due at 11:59 p.m. on the 11th. So opens on the 7th, closes on the 11th. Sounds lucky, 7-11. Certainly, as you have any questions about that, let me know, but everything will be very familiar for you, which I think is a good thing because at this time of the semester, you're probably overloaded with a lot of other stuff too. I know it's a busy time. So let's go ahead and take a look at the chapters, the material which was in the chapters. I'm going to be reviewing that on a rather high level with you today. And then as you have more questions, just let me know. I'm happy to address them here during this time or at any other time. We can do email, we can do Zoom, whatever works out for you. So let me go ahead and go to the material, the notes specifically. By the way, the questions are broken down evenly. I've got 12 questions on the first two chapters and 13 questions on the last chapter. So very even breakdown. So that first chapter on the exam was chapter 24, and I'm going to share my screen on that. There we go. Here in chapter 24, we were talking about a few different things. We talked about decentralized operations and responsibility centers, how we evaluate performance, and something called the balanced scorecard. So the first thing we talked about were decentralized operations. So an organization is either very centralized, which means top-down, headquarters rules everything, or decentralized, which means that lower level employees help run the show. So most organizations have evolved into something a little bit more decentralized as opposed to what they used to be many years ago. By the way, you can think of centralized operations like a dictatorship, decentralized like a democracy. In fact, we can apply those same terms in poli-sci. So, well, we talked about some advantages of decentralization and some disadvantages. And when we're decentralized, we need to identify different centers within the organization as responsibility centers. So we had cost centers, revenue centers, cost center responsible for generating cost. Most centers in an organization are. Revenue centers responsible for generating revenue, like a company's sales operations. A profit center, like a little business within a business, responsible for generating a profit. And then the big one is an investment center. So it has control over the amount of assets invested in it. And we're going to evaluate that based on things such as return on investment. So an investment center is something like a subsidiary of a company, trusted like another business to run its own operations. So you should know what the concepts of those are. Then we talked about performance measurement. And one of the biggest ways performance measurement that we have is called a balanced scorecard. And it's trying to keep everything in balance. So it looks at the financial perspective, but it's also a means, as we know, of looking at the customer perspective, the internal business perspective, and the learning and growth perspective. With each of these, we had some key performance indicators, also known as KPIs, that we've looked at. such as financial perspective, we would look at traditional accounting numbers, such as profit. So do be familiar with those KPIs, which are in your book as well. Then we also had some other ways in Roman numeral 3 of measuring the financial performance of cost, revenue, and profit centers. So those were pretty easy to understand. And then with investment centers. Again, it's a large division. We look at return on investment. And we had the formula here. We broke that down a little bit. So any questions there that you have on the exam, you can plug and play the numbers there. Also, we looked at residual income. We looked at minimum acceptable income. For all these, higher is better. So the higher that investment center can go, the better it is. And then we had another way of looking at investment centers in terms of evaluating them. It is EVA, economic value added. So there's the formula for that. Again, higher is better. We always love more economic value add. And that's something else that you will see in the managerial finance class, by the way, along with some of this other information. Then we had some limitations of financial performance measures. In fact, what we just talked about are financial performance measures. And that's it for the chapter. Not a bad chapter whatsoever. So what questions do you have there on chapter 24? Anything I can answer? All righty. Let me go back to sharing my screen. Then in chapter 25, we shifted to short-term business decisions. So short-term, it means within 1 year, generally. Although one of these got a little bit longer than a year, that's okay. So we're looking at business decisions. We have at least 2 alternative decision scenarios that we can choose from, such as whether to keep an old machine, scenario A, or whether to replace it with a new one, scenario B. And we're analyzing this primarily from a financial standpoint. So we're looking there at what contributes the most to earnings. Generally, we translate that into the cash basis. We look at revenue as cash inflow, expenses as cash outflow, profit is how much cash is left over. So, little introduction. And the biggest thing from this will be relevant costs and relevant revenues, sometimes called differential costs, differential revenues. Those do change between the decision alternatives that we're considering. So they matter to our decision. We do look at those as we do a financial analysis, of each of the decisions we have. Then some costs and revenues are irrelevant. They don't make a difference. It is usually because they do not change between the 2 decision alternatives. And one very special type of an irrelevant cost is a sunk cost. That is based on a past decision. We cannot recover it now. And also any non-cash expense like depreciation or gain or loss on disposal of old assets, always irrelevant because they're non-cash. Then just a little reminder, we have to be careful about fixed costs and make sure we analyze them carefully. And the first decision that we had was deciding whether to keep or replace an old machine. So we had an example here. The example on the exam will not be as long. And we had the long way of analyzing it and the short way. You can do the short way on the exam. So I just care about the final number that you get. We also have product mix decisions resulting from limited resources. We decided that we could produce only one product at a time, and we had a limited resource, such as in our example in class, a limited supply of plastic, a raw material. So our goal is to max out the contribution margin per unit of the limited resource. That's how we maximize our profit. That's exactly what we did here with the plastic. So any questions about the machinery placement or about product mix decisions with limited resources at this juncture? Okay, again on the exam, get through the example here in class, and we did have a PDF of the solutions, as you know. Get through this, you're good to go. You can do the exam question just fine. Then we had in-source or outsource. In-source means we make our product. Outsource means we buy our product. So for example, at Publix, when we go shopping there, a lot of those products are actually made by Publix with the Publix brand label, but some are not. So some are in-sourced by Publix, they make them. Some are outsourced by Publix, they buy them from someone else. So we analyzed whether we should in-source or outsource. We had two different scenarios. One was without an opportunity cost, one was with an opportunity cost. Be able to work both these two examples we had in class. And again on the exam, if you understand these, you'll do just fine on the exam. Do you have any questions about in-source or outsource? Okay. Next one that we had was whether we're going to keep a customer. So looking at that customer's profitability. I gave you this hierarchy of costs. I don't think I had a question on it on the exam. If I did, it's very easy. But concentrating primarily on the examples we had that we worked together. We had the Sarasota Sailboat Company thinking about outsourcing a part. Two scenarios. One was without an opportunity cost. One was with an opportunity cost. Again, be able to do both those, and you'll be fine. Any questions here about customer profitability? Next scenario was a one-time only special order. So here comes a customer to us, and they say we want a large quantity of your product, but in turn, we want a special price, lower than that offered the general public. Excuse me. So that can be a very good way to fill up excess plant capacity. So in our first scenario, that's just what we did. We were selling arrows. We had 2,000 units of excess plant capacity, and the customer wanted only 1,000 arrows. So good, we fill up half that excess capacity. And we were willing to do so at a price which was lower than we normally offered the general public. So this first scenario was a winner. We accepted the special order. Second scenario was a loser. We did not accept it. The reason is we had an opportunity cost there. And that was due to lost sales to regular customers. The reason is the special order went beyond the total capacity. In the second scenario, we only had 300 units of excess plant capacity. Special order customer wanted 1,000 units. That means we would have to take away sales to regular customers at the regular higher price. Not good. Terrible opportunity cost. Therefore, we did not accept this special order in the second scenario. And just have a few little notes after that about special orders. Questions there about special orders? Then, the last scenario about this, before we got to the pricing part of the chapter, was whether we sell the product as it is or process further. In this case, process further by adding some starch to shirts. So we saw that we will process further if the incremental revenue, the extra revenue that is, exceeds the incremental cost, the extra cost. It did here by $1.50. So the answer is we'll offer further processing to our customers. In other words, charging shorts. And the reason is simple, because we take in more revenue than the incremental cost to starch those shirts. We take in $2 of revenue, charge the customer an extra $2, we starch the shirt. We only spend 50 cents to do so. So we net $1.50 there. Pure profit to us. Questions here on sell as is or process further? I'll stop my share and come back on screen here for a moment. Anything? Or anything else for that matter so far? Okay. Then the last part of the chapter was about pricing. So with this, I was just interested in conceptual issues. So we know that in the long run, we've got to set a price which is greater than our full cost for the product. And full cost means the sum of all upstream, downstream, and manufacturing cost. They're in the value chain, both fixed and variable. So that's pretty simple. Long run price has to be greater than long run full cost. Then we had two different ways of setting a price: cost-based or cost-plus pricing and market-based pricing. So cost-based pricing, companies which are in less competitive industries can do that. So monopolies, oligopolies, regulated industries, or if there's no outside market for a product, they can do it. But that's where the company simply adds its cost up, adds a markup to that cost per unit, and that's how much it charges. Well, that's nice, but if there are competitors around, you're not going to be able to get by with that. Sorry, I forgot to share my screen. There we go. Right here on cost-based pricing. So a lot of companies think they can use cost-based pricing. They open their doors, they find out they can't. So instead, most companies are forced to do market-based pricing, sometimes called target pricing. And that's where the price has been set for you by the market. So competitors, they've essentially already done that. General public will not pay more than a competitor's charging. So you have to set your costs low enough because your market price has been set. And we said one of the biggest places we see this in pure competition. And agricultural commodities are a pretty good example of something close to perfect competition. So the price per bushel of wheat, per bushel of corn, etc., is set by entities such as the Chicago Board of Trade. How well I remember as a child growing up near Chicago. But farmers had to watch the Board of Trade and make sure that their cost per bushel of wheat or bushel of soybeans or whatever, or pork belly, that's another agricultural commodity. That's where bacon comes from, by the way. Well, farmers had to make sure that those commodities did not have a cost per unit, which was greater than the market price. If the cost per unit were greater than the market price, too bad. That's why a lot of small farms are no longer with us. Talked about a few different things here, which were pretty easy concepts. Just be familiar with those. And that takes care of chapter 25. Questions there on chapter 25 before we go to chapter 26. Okay. Share my screen again. So chapter 26 about capital budgeting. Here we shift from the short term to the long term. So we're talking about more than a year. So we're making capital investment decisions such as whether to buy a new major asset or build a new building or invest in a new project, as we did in the example problems we had, which was the ski lodge. And again, we're looking at cash inflows and cash outflows. We know that this budgeting, it may appear to be precise at first blush, but we're really working with guesstimates. So from time to time, we may have to audit this project as the years go on. So a so-called post-audit to see if things are still on target. And we had 4 different methods. First method was the payback period method. So this is how long it takes to recover the initial cost. So how long does it take to recover that initial cost of the project? And what we do is we divide it by expected net cash inflows. At least if those net cash inflows are equal. That was our first scenario. The second scenario, if they were unequal, we just had a little bit more work. We just had to keep going through things until we were paid back. But with payback, shorter is better because we want our money back faster. So on the exam, if you can do both these, they're easy. I think you'll certainly be more than fine. And it's a rather simple method. So it's usually an initial screen, and then we subject it to something more robust, something with better information value, something probably with time value of money. We'll get into that in just a bit. Before we do, our second method also does not depend upon the time value of money. The accounting rate of return method. This is the one that does use accounting numbers instead of cash flows. So we had some adjustments to make to get from cash flows back to accounting numbers. And with these formulas on the exam, just plug and play. And of course, we had some examples of the payback period method and the accounting rate of return method. So let me stop there for a moment and see if you have any questions about the payback period method or the accounting rate of return method. You'll have your notes in front of you, so that's why I often say plug and play. Okay, so I come back to sharing. Next thing we had to do is to take a little break from the methods and talk about the time value of money, because we had to do that for the last 2 methods. So we did this and we had some interest rate factors. On the exam and the questions, those interest rate factors are given to you. You're given several of them and you pick the right one out. Even if you weren't, you could go to the tables of interest rate factors and pick them out. So we know that if we have $1 today, we can invest it and make it grow and have more in the future. That's what this is all based on. So we calculate each of these, the present value of $1, sometimes called the discounted value, because the present value is always less than the future value. It's discounted. Then second, the present or discounted value of an annuity. That means a stream of equal payments. Then we switch to future value. Future value of $1, how much will be worth in the future if we draw it out of our bank account, with interest, of course. And the future value of an annuity, a stream of equal payments that we will receive. We had an example of each of these in H. And the solution for each. I want you to be able to do each of those. I gave you, I think, a couple of those on the exam, so you'll be more than fine. Any questions there about the time value of money? And again, you'll see that in managerial finance, as well as a lot of other capital budgeting information too. So we went on to the net present value method of capital budgeting. So it's simply the difference, the net difference between the present value of the investments net cash inflows, and the investment's initial cost. And we just did it with equal periodic net cash inflows, the same amount per year. So we have an annuity, stream of equal payments. A net present value is simply the amount of each period's net cash inflow times that annuity present value factor. That's how we get the present value of that annuity minus the investment's initial cost. And obviously we want the present value of that annuity to be higher, as high as possible. So we want this difference to be as high as possible. So more is better. You can skip C. They may do that in finance. D, we did see this in one example. If the asset has a residual value, then we discount that as a single lump sum. And we add that present value to the discounted amount of the net cash inflows. So it would go right there. And again, that general decision rule is companies going to decide to invest in it if the net present value is greater than 0. But again, higher is better. We also saw the profitability index here, which can help guide us with decision making. So as I come back, do you have any questions so far? Anything about net present value or back with the time value of money for that matter? Alrighty, I will share again. By the way, just go over those couple of problems for net present value and you should be fine. Then we have the internal rate of return method. So this one, it's going to calculate the rate of return that a company can expect to earn by investing in the project. And that internal rate of return is going to be the interest rate, which makes the net present value of the investment equal to 0. So at the present value, the investment's net cash inflows minus the investment's cost equals 0. We're going to force that to happen. And the higher the IRR, the more desirable the investment. So again, more is better. We always want a greater rate of return. And we assume that periodic net cash inflows are equal. We have an annuity. So we went through this and we had to search for that present value factor. In the table, the corresponding interest rate, at least to the closest percent, is the IRR. So solve for that. Look it up in the table. And again, you'll be given interest factors. Random ones on the exam, or if you prefer to use the table, you can. Don't worry about E. That's when they're unequal. They may do that in finance. And we had an example of it in the book. So not too bad there. So questions there on IRR. Or for that matter, any questions about any of the other material? So do go back over it. You'll be all set for the exam and you won't even need 150 minutes. And again, as always, if you have any questions about that material or anything else about the exam, just let me know. Always more than happy to help. Did you have any?
Thank you.
Oh, I'm sorry. Please go ahead.
I was just saying thank you for everything you've done for us.
Oh, well, thank you. I am so very, very appreciative of everybody. And, you know, getting ill was the last thing I ever expected at this juncture. I've always been healthy all my life. And I'm on the road to recovery again, getting healthier. But come fall, I'll be back in full force. Hey, can't hold me down. So I'm really feeling a whole lot better. And I so appreciate everyone bearing with me, everyone's patience. And like I said, the amount of kindness I've received and thoughts and prayers has been beyond me. I've really, really been overwhelmed by that. So, yep, just wanted to let you know. Yeah. So wanted to make sure that you all had a good time this semester, even though we had to end face-to-face, unfortunately. I'm very sorry about that, but I hope we made the best of it this way. And it's a good thing, I think, these days we have remote learning too. It's a good supplement. And it also gives people a choice. Some people do want to come live to class, some don't. Some people cannot come live to class. They may be ill like me, and I've had students who were ill and had to stay at home. It's helped them. I've had students around the world. I literally have. And I think that we can expand our outreach and reach a lot more students. And also some students may need to stay home for various reasons. Expenses are one, another one, an internship or other job, or helping out with family. So I think remote's here to stay. Again, as a supplement. So I think it's good that we'll have a choice, face-to-face or remote. Do you have any questions about the exam administration? Again, it'll be just like before.
I missed the beginning because my audio was connecting. It's multiple choice again, correct?
It is.
Okay.
Yes, and I'll go ahead and share my screen with you here. I sent this in the email to you. It's a breakdown of the exam. And it's this. So you'll find that there in your email. And 40 multiple choice. So they're divided evenly between the 3 chapters. Whoops, it looks like I've got 39 multiple choice. I apologize. Oh, I know what that means. You get a free question. You already got one right. Cool. All right. Other questions so far? Well, you all have been a great group of students. I just really want to say that. So I've enjoyed you all so much. I hope to see you around in the fall. I'll be there and you'll be there. So please, whenever you see me, you come up and say hi. I'm always there and eager to talk. I miss interacting with people face to face. So I need to make up for lost time this fall. So please help me. Okay, good. So again, please let me know if you have questions. And I sincerely hope you enjoy your summer. Have a great summer and God bless. And like I said, I'm going to look forward to seeing you. In the summer, if there's anything I can help with, you let me know. I'm pretty knowledgeable about a lot of things. So whenever you have a question like, is this going to be the right internship for me or something like that, I'm more than happy. I go way beyond the class.
Thank you. Have a good summer.
Thank you. You too.
Thanks, Professor.
Thank
Get
you.
well.
Thank you. Yeah, feel better.
Have a good
Appreciate
one.
Thank you so much.
Thank
Bye.
you. Bye-bye. God bless.
Bye.